Let me suggest a different reason to start going long Bitcoin, which has nothing to do with foreign currencies, but a lot to do with policy in the United States. There's two bills floating around, but let's talk about the one that has the chance of actually getting passed in the US after November 8th, which is the midterm elections. It almost went to markup last week. It's called the Stablecoin Transparency Act. Now, this has nothing to do with Bitcoin, but it has a lot to do with the tone of regulation. And the reason I think it's interesting is they're trying to solve for the challenges that occurred in these collapses of stablecoins that were built around algorithms. 62 billion got erased. The regulators got upset about that, although the majority of that capital, because it was decentralized, was in other countries. But this act is very simple in nature, which is why it may pass. It's being supported by both parties. And the reason that's the case is that it makes effectively the US dollar the default payment system worldwide, which everybody can get behind. So if you have USDC or any other stablecoin that's backed by the dollar, and the test to get it regulated is very simple. You're going to get audited every 30 days. It has to be backed up 1-to-1 with a dollar or a treasury bill. All the treasury bills backing the coin or the token have to have a duration of less than 12 months. And if you're willing to go through that scrutiny, they'll issue you a license. Now, if that were to happen, and it may happen very quickly after November 8th if the House flips, and that's the anticipation is House flips, nobody knows what's going to happen in the Senate, that's a coin toss. But even though it has nothing to do with Bitcoin, that'll be the first regulation passed by US regulators. And I would argue you want to be long Bitcoin going into that outcome. So if you own stable coins, you're going to see a lot of interest in institutional capital coming into, let's say, USDC and Circle. Circle, by the way, took in $200 million in Fidelity and $200 million from BlackRock a few weeks ago in a Series F at a $9 billion valuation. They got $54 billion of coin. So end of the day, regulation comes, Bitcoin goes up. And I agree with your thesis that it's a good asset to have if you're in a country where your currency is collapsing. But if institutions smell policy, then you've got a real move up. And that's when you break out of this $19,000 to $22,000 trading range against the US dollar. I think it goes right through that very quickly. Here's a question for every investor to think about. There's a risk in investing in Bitcoin and all crypto. There's also a risk of not investing in it, because if it's true that it becomes the 12th sector of the S&P in the next decade, some of the value in financial services stocks like banks, like money center banks, are going to transfer to these new technologies. And you simply don't know when that's going to happen. So my thesis is you should have some crypto in your portfolio because you don't know when that's going to occur. And if you completely don't have exposure to it, you may miss participating in the growth of this 12th sector of the S&P, which would be a bad outcome for performance.
How much of your portfolio is currently in crypto?
It was 20% before the correction. It's now 16.2. We monitor it every day, just like we do stocks. We're having a very hard time with our auditors and internal compliance people because it doesn't act like an equity. It doesn't act like a bond. It trades liquid 24 hours a day. So mark to market means nothing at 4:01 in the afternoon. So we're constantly monitoring that. But I'm not the only person that has this view. We are adding to that position because in the way we manage our operating company's portfolio, we can have any sector up to 20%, but no more than 5% in any one position. So given that, we have a lot of different positions, and we just put capital to work in Miston last week, that project that came out of Facebook. We're always looking for new projects because we simply don't know which ones are going to survive. But we don't need them all to survive. We just need a portion, just like venture investing. But crypto is going to cause a lot of disruption, in my view, in financial services, which is a large sector of the S&P. So if you don't invest in it, you also have the risk of missing that transition. We're constantly rebalancing as we do at the end of every 30-day cycle. We look at our positions, not just in Bitcoin and crypto, but across the portfolio. Fixed income has been as challenging as stocks. They've gone down just as much in the last 18 months. So it's been a very difficult time for every asset class. We can't own more than 5% of the operating fund in Bitcoin. You just simply don't know when these asset classes are going to move. I have a personal speculation around regulation. I talked about that earlier, that if the Stablecoin Act gets put into law, that will be a signal that all crypto will be regulated at some point. Some people feel good about regulation, others don't. But here's a fact to consider regardless of your position. Most of the sovereign wealth funds that I work for as an indexer have zero position in crypto of any kind. When you ask them if they're going to buy anything, they want the granddaddy, which is Bitcoin. They're willing to put 50 basis points to 1% into Bitcoin when their compliance departments allow them to. And that won't happen until the SEC rules on it as a commodity or a security. And the reason they can't is that these sovereign wealth funds, I don't care if you're Norway or you're UAE or you're Saudi, the majority of their money is put into the S&P. It's the only market that can absorb $1 billion in one trade without moving the market. And that goes in around 10:05 every morning when these sovereign wealths take their 250 million that they make in oil each day out of New York. These transactions, remember, oil is transacted in US dollars, and they put it into an index of the S&P X oil, X airlines, because they own their own airlines and they have enough oil, obviously. But the reason they won't buy Bitcoin is they can't go uncompliant with the SEC. That's the number one depository for their capital. So until the SEC makes a ruling on what Bitcoin is, they won't participate. Now here's the upside. 50 basis points in the sovereign wealth and pension world is $1 trillion of buying. So you have to be voting and cheering on regulation. You put $1 trillion into Bitcoin, that's when you might see it at $60,000 to $100,000 valuation. And those funds don't care. Once they index it, they're the automatic bid when it dips below the 50 basis points or 1% they've decided to own, and they sell into strength. So there's a really, really liquid market about to happen. That's very optimistic for Bitcoin, not pessimistic. I really don't understand when people say, oh, I hate regulation and decentralized asset. You want regulation because that's where the money is. Well, it's kind of interesting from the macro perspective. If they lose the House and they keep the Senate, what you get is gridlock. There'll be no more spending bills for the next 2 years because there'll be nothing done in Washington in that situation, which is good for the markets, for the equity markets. Remarkably, it's kind of indifferent for Bitcoin and crypto because what you find in all of these bills is bipartisan support, which is really something else. You look at Haggerty and Gillibrand, that's their bill, which contemplates Bitcoin as a commodity, and it deals with NFTs and lots of others. But there's 21 bills floating around the Senate and the Hill, and they're all bipartisan. So it doesn't really matter what happens. The only reason there's no crypto policy is everybody's focused on November 8th. But when they sit again in the back end of the year and they come back from holiday, they're still supporting crypto. Both parties like the idea of some regulation on crypto. So it's more about the gridlock of getting no more spending bills that the market may like, because most of market participants have seen enough spending. I mean, it's just, we did the 6 trillion and then we did the Anti-Inflation Act, which was very inflationary. And then we gave the students back all their debt, which is nuts. And so everybody's sick of the spending. I think that's the opportunity for equities. Doesn't really change the outcome of Bitcoin. That will one day be regulated. The way I read it was the Fed's going to raise rates 75 basis points. There's no question they're going to keep going. You're printing an inflation CPI number of over 8%. What no one knows, though, is how much of this inflation is caused by supply chain issues. Because, I've got a pretty good lens on supply chain issues. I have 54 private companies in our portfolio. Everything from gym equipment to greeting cards, commercial kitchens, wireless charging, you name it, we're involved. And when we talk to the CEOs of these companies, they're still having a really hard time. Let's just take the gym equipment company in Fargo, North Dakota. We used to get our metal from Asia. We can't get it anymore. We can't get it through the port in Los Angeles. We have to make the barbells and all the gym equipment in the US, cost 30% more. We pass the price on to the consumers. They're still buying it. And that's inflation. Now, as soon as we get the supply chain thing worked out, we'll be dropping prices, but we haven't been able to get it worked out yet. So I think half the inflation, frankly, from my point of view, is this temporary supply chain, but I don't know how temporary it's going to be. I've been waiting a year now to fix just the gym equipment story, and it hasn't been repaired yet. What point do they indicate that they're going to stop? Because another 75 basis points already anticipated in the 2-year. You're about 4.5% on 24-month money. The stock market is fibrillating. It's having a lot of volatility. The VIX is trying to figure out the moment the Fed pauses. And so this is the interesting challenge. What happens in these cycles, and this is always a challenge, and we have a good example in recent times, 2020, in the middle of pandemic, total chaos around the world and the markets. The stock market actually did quite well because there was all this QE coming into it, this quantitative support and the Fed printing money. But all of the returns, 95% of the returns came in basically 18 trading sessions, 18 8-hour periods, where you had that volatility, 2,000 points up, 2,000 points down. You just didn't know which day those up days occurred. And so if you were trying to time the market, you missed the entire returns of the year. The same thing is going to happen here. As soon as people figure out or feel or just get the tone from the Fed that they're going to take that pause, you're going to have a violent swing up in the market. And if you're not in the market that day, that's half your returns you'll miss. It'll happen in a few days. And so, everybody tries to time the market. It's impossible. Everybody learns the hard way. I did years ago. So I stay the course. I try and add a little bit on down days into just an index. I use a broad index of both mid cap and large cap stocks that Alps put out, and shameless in telling it's OUSA and OUSM. But those indexes are 300 really high quality stocks in the US that pay dividends. And they're violently volatile, except yesterday was crazy up. So I'm glad I was in the market yesterday. Same thing could happen today. You just don't know. Timing is impossible, and this volatility makes everybody squeamish.